Thanks very much. We'll see. So I've gathered from talking to a few of you here today that a few of you in this room are interested in the exchange rate. So I was only going to spend a couple of minutes of it on that topic, but I think I might talk a little bit more about that because it does seem to be a bit of an interest in that area. I'm very honoured to be here tonight, and I actually feel somewhat humbled to be here tonight. I attended some of the presentations this afternoon, and I was incredibly impressed by the material that was presented. I was incredibly interested by the material that was presented and just the sort of innovations that are happening in the agricultural sector, and which I found quite remarkable, and something including a number of areas that I hadn't really thought about before. And just to see the amount of innovation going on in agriculture at the moment. I mean, a lot of the time, we at the Reserve Bank in particular hear a lot about some of the not so good things going on in the agricultural sector. And to see the positivity around a lot of the topics which are being discussed, when I was there this afternoon at least, about developments which are going to take agriculture forward was incredibly interesting and very inspirational, I suppose. I'm very honoured to be here tonight to talk, to give the George Wilson Oration. Having read a little bit about George, I noticed he lived life to the full, which I wholly condone. The other thing which I noticed, which I think may be of interest to the current crop of scholars, is that at least when George went on his scholarship, he was given and went to the UK, he was given a bicycle to go around and have a look at the places he wanted to have a look at. It's interesting in a number of respects. One, because at the moment, so I do a bit of bike riding myself, at the moment there's a cycling race called the Tour of Britain on at the moment, and given George's experience at the time, he probably would have been a fairly decent competitor for Bradley Wiggins at the moment. Given his experience when he was given the bicycle. But I presume these days that the awards stretch a little further than here's a bicycle, go and have a look at a few places you might be interested in. So I suppose today's scholars should be somewhat thankful for what they've got, that they are getting a little bit more than a bicycle. So what I'd like to do tonight is talk about, to do a couple of things. First of all, talk about three things relating to what we do at the Reserve Bank and its effect on the agricultural sector, and try and put in context, or one, explain what how the agricultural sector feeds into the thinking of the Reserve Bank Board in the way that it makes its decisions. Also explain to you a little bit about what we do in my area of the Reserve Bank, which is the financial markets area, and we do have, I suppose, primary responsibility for the exchange rate, which is of primary importance in the agricultural sector, and how we think about that. And then I'd also wouldn't mind looking forward a little bit, although having seen some of the presentations earlier today and the way that they're looking forward for the agricultural sector, I'm not sure that I'm going to be as inspirational, but look forward a bit and think about a couple of the main drivers of the agricultural sector over the next decade or two. So let me start by talking a bit about what the Reserve Bank Board does and how it comes to its decision each month. So basically, the board considers all aspects of the Australian economy. So the way the process works is that each month when the board gets together, the first Tuesday of every month, except for January where we get a month off, each month the board gets briefed on what's happening in the economy and what's happening in financial markets. Now, I'm responsible for briefing them on what's happening in the financial markets, and one of my colleagues is responsible for briefing on what's happening in the economy. One of the main inputs we have to that process is the information we get from our liaison program, which extends right around the country. And in each capital city, we have an office whose primary responsibility is to go out and talk to people and find out what's actually happening. So we also have this thing called the Bureau of Statistics, which tells us, after a period of time, what may have happened about 6 months ago in the economy. But there's no disrespect to them, they can't do it any better than that. But partly because of that, we the board needs to make a decision reflecting what's actually happening in the economy now, rather than what might have been happening 3 months ago or 6 months ago. So we have a very extensive business liaison program in each city, which goes out and talks to about 100 businesses each month to find out what's actually going on. Now, a decent chunk of those businesses are in the agricultural sector, partly depending on which state we're talking about, but for instance, Virginia, who runs the office here in Perth, spends a fair bit of time either up in Karratha talking to the mining industry, or down south talking more in the agricultural industry to find out what's going on. Similarly, in the Adelaide office, spends a lot of time talking to people about what's going on in the agricultural sector in South Australia. In Melbourne or Sydney, maybe they're talking to more businesses in manufacturing or in the services sector. But the board pays a lot of attention to the information they get coming through our fairly extensive liaison program. As you all know, the board also consists of, like in a number of other countries, a number of business people who bring their first-hand experience about what's happening in their part of the economy to the decision. So the board's decision is very much based on, as best as it can be, on real-time information about what's actually going on out there in the economy. So it's not based on, as I said, a bunch of statistics. We're, to put it crudely, I suppose, not sitting in an ivory tower divorced from what's actually going on out in the economy. As best as we can, we try and feed in information about what's actually going on out there at the moment. And that's actually has a very large influence on the decision the board makes each month. So the board makes its decision, then it says that every Tuesday at 2:30 it says the cash rate target is going to be, at the moment, 2.5%. So what does it actually mean, and how does that actually affect everyone in the world, everyone in this room, and how do we at the Reserve Bank actually go about implementing it? So the primary responsibility for implementing the board's decision actually falls to my department, which has a large operational element to it. Maybe I'd just like to take you through exactly what we do each month when the board announces its decision, and explain how what we do in setting the cash rate target affects what you do in terms of borrowing, in terms of if you're a saver, which is not like me, I'm a borrower, and I assume a number of people in this room are also borrowers, but there are some people out there, I believe, who are actually saving and have deposits, and they care about the deposit. Probably more over on this side of the room, I guess. Whereas I suspect a number of other of you are carrying a mortgage like myself, or are carrying a loan against your property, and all care about the borrowing rate. So we, in my area, we're actually responsible for making sure that when the board says the cash rate target is 2.5%, that's actually what it is. And so the way we go about that is that the cash rate is actually a fairly obscure rate in the overall scheme of things. So what it is actually, it's the rate that banks borrow between each other overnight in what's called the cash market. So there's not a lot of, it's not a very big market in the general scheme of things, but it actually determines every single interest rate in the economy, both on the deposit side and on the lending side. And we at the Reserve Bank have complete control over that rate because we're the only supplier of cash in the economy. So all the banks demand cash, we're the only supplier of the economy, and as some of you may know, if you have a complete monopoly over things, that gives you a reasonably decent control over the price. I suppose some of you are on the receiving end of that from Coles and Woolworths, but we at the Reserve Bank have complete control over the supply of cash, and the banks are the ones that demand from us. The cash market itself is actually extremely small. It's only about, at the moment, it's only about $1 billion. And $1 billion in financial market terms is actually a small number, not a big number. And the reason why we have complete control over that is because all the banks in the economy, all Australian banks and foreign banks operating in Australia have to hold an account with us, the Reserve Bank. And they're never allowed to go into overdraft on their account. So every single day they have to make sure that they've got a positive balance with us. Each day they receive all sorts of payment flows. So if you go and pay your electricity bill and you pay it either over the internet or even if you just walk into the bank and pay it by cash, your electricity company has its account with one bank, you have an account with another bank, and the money moves from your account with your bank to the electricity account with their bank. All of those transactions actually go across our book, the Reserve Bank's book, in the course of that transaction. At the end of each day, all the banks look at their books and say, as a result of all these transactions, this is what my balance is. I've got to make sure I've got a positive balance with the Reserve Bank. And they borrow and lend cash amongst each other to make sure that they have got a positive balance. And that rate at which they borrow and lend to each other is called the cash rate. We make sure there's enough cash overall in the economy to make sure that every bank can have a positive balance at the end of each day. And by the way that we control that supply of cash is the way that they make sure that that the cash rate is where the Reserve Bank Board wants it to be. Now, the main way that cash is withdrawn and injected into the economy is actually through the government. So every time you pay taxes, you should all pay taxes, but every time you pay taxes, that takes money out of the economy. It goes out of your account into the government's account. Every time the government does some spending, it goes the opposite way. The government has its bank account with us at the Reserve Bank. And so when that money goes, when you pay your taxes, that's taking money out of the account, out of the economy. We at the Reserve Bank offset that by injecting some cash back into the economy to make sure there's enough there overall. So through that system and the fact that we have the government's bank account and we have complete control over the supply of cash, we're able to make sure that this thing called the cash rate, which as I said is a fairly esoteric interest rate in the general scheme of things, is where the Reserve Bank wants it, where the Reserve Bank Board wants it to be each day. So the banks, so we make sure the cash rate is where it needs to be. So how does that affect every interest rate in the economy? So the reason is because ultimately that's the banks, or the banking system's ultimate source of funds. So they have to look at, if I go and borrow so if a bank borrows, it raises the deposit. So if I'm going to raise a deposit to fund myself, how does that price compare to the price I get from borrowing from the Reserve Bank? And so the deposit rates that they're willing to offer you is affected by the cash rate that we set. Now, in the last few years, deposits have become a much more attractive form of funding for the banks, and so they're paying you a lot more to have a deposit than you'd say 5 or 10 years ago. Partly that's because as a result of what we've learned over the last, well, not necessarily what we've learned, what we've remembered over the last 5 years. We knew this about 30 years ago, forgot it and remembered it again 5 years ago. As a result of the financial crisis, deposits are generally a good way of funding the banking system. It tends to be a more stable way of funding the banking system. And so the banks have reappreciated the value of that stability and are willing to pay you a bit more for a deposit. But nevertheless, broadly speaking, they're saying, how should I fund myself from a deposit, or should I fund myself by borrowing from the Reserve Bank? And so they'll base their deposit rate on the cash rate that we set. When the cash rate moves up, at the moment it's mostly moving down rather than up, but as it moves down, they'll say, well, I'm going to move my deposit rate down because I don't want, otherwise I'd rather just go and borrow from the Reserve Bank. The other source of funds I have is to borrow from global financial markets. So the banks fund themselves about 30 or 40% of their funding comes from global financial markets. Again, that still is ultimately priced off the cash rate that we actually set. So as we move the cash rate up and down, those rates that they can borrow in global financial markets move up and down. And the reason why I'm talking about how much they paid to raise their funds is because how much they cost to raise their funds determines how much they're willing to lend you at, the rate they're willing to lend you money at. Now what's happened over the past 5 years is that in addition to the cash rate, there have been other influences which affect rate at which banks are able to raise money. So banks are now perceived to be a more risky proposition than they were 5 years ago. So investors are demanding more to provide funds to banks. So that premium, that risk premium on banks has gone up quite a lot from where it was 5 years ago. All of that means that the bank's cost of funds, they're paying more for deposits, they're paying more for buying from investors. That means their overall cost of funds has gone up quite a bit relative to the cash rate that we set. In the end, that means that lending rates are higher relative to the cash rate than they were, say, 5 years ago. So if we go back to 2007, every time we move the cash rate up and down, lending rates move up and down 1 for 1. That was actually more the aberration rather than the way things normally work. Now we're in a world where when we move the cash rate, lending rates move mostly in line with what we said, but not necessarily 1 for 1. And that's because the price that the banks are actually having to pay for their funds is moving in a different way from the way it used to be. Nevertheless, we still, at the Reserve Bank, have the primary control over the lending rates that everyone's able to borrow at, and also over the deposit rates that everyone's able to receive. So, while that control is not as tight as it was in the decade prior to 2007, it's still fairly reasonable. And we're still able to take that into account when we set the level of the cash rate. So, when today we're sitting at a cash rate of 2.5%, where lending rates are as low as they ever have been. In days gone by, back in 2007, if we'd had the cash rate of 2.5%, lending rates would have been even lower, but the board takes that differential into account in determining the sort of overall structure of lending rates that it wants to have. So the bottom line of all of that is we still, at the Reserve Bank, have very large control over the borrowing rates that everyone can borrow at, over the deposit rates that everyone can receive on their savings, even though the relationship isn't as tight as it was for most of the 2000s. So ultimately, broadly speaking, you can still blame us for your borrowing rates rather than your bank. So as I said, we, for our, in my area, we have a responsibility for setting that cash rate, which still means we still have the responsibility for setting the overall structure of lending rates in the economy. The relationship's not exact, and nothing in economics is particularly exact, and it's less exact than it was 10 years ago, but it's still not too bad. So let me now turn to talk a bit about the other thing that our operations affect, which is the exchange rate, which I think is probably at least as much interest to everyone in this room. So in my department, as was mentioned, so we manage the country's foreign exchange reserves, which are around about $40 billion at the moment. The other thing we do is we do all the government's foreign exchange business in the market. So every day that the government decides they want to go and pay the US Embassy, or the Australian Embassy in the US, or they want to go and buy a destroyer or something like that, the government comes to us, we give them we don't give them the foreign exchange, we sell them the foreign exchange, and we transact in the market to cover that. So we operate in the foreign exchange market every single day to do the government's business, which means we get a very large amount of intelligence about what's going on in the foreign exchange market. Now, for the last few years, as you are all no doubt well aware, the exchange rate has been at a fairly high level. That's mostly not got to do with what's going on in Australia, it's got a lot to do with what's going on in the rest of the world. So, unlike Australia, the rest of the world, as you're all well aware, has experienced fairly tough economic times for the last 5 or 6 years. And other central banks elsewhere around the world have reduced their interest rates to zero. And when they got to zero, they decided the economies needed even more stimulus, and in central banking terms at least, they expanded their balance sheets. In the general vernacular, they printed money. And the result of that was that their exchange rates went down, our exchange rate, particularly the Australian dollar, went up. So our exchange rate has been at a high level up until at least about 6 months ago, mostly because of what was going on in the rest of the world, and the fact that while the Australian economy was experiencing reasonably decent growth, the rest of the world wasn't, and other countries were printing money and had their interest rates at very, very low levels. So we, at the Reserve Bank, were uncomfortable with the level of the exchange rate. We responded to that by lowering interest. The board responded to that by lowering interest rates to particularly low levels. That wasn't necessarily to try and bring the exchange rate down, although I'm sure everyone in this room would have welcomed the fact that the exchange rate might have come down. But it was mostly to try and provide an offset to the effect of the higher exchange rate on the economy. In the last 6 months or so, the exchange rate actually has come down up until, I'm going to say this as of 48 hours ago. I'll explain what's happened in the last 48 hours, but as of 48 hours ago, the exchange rate had come down about 15% from where it was about 6 months ago. That was almost entirely due to what was happening in the US and not very much due to the fact that we at the Reserve Bank had lowered interest rates by another 50 basis points. So the main driver of what's been going on in our exchange rate over the last few years has really been what's been happening elsewhere in the world rather than necessarily what's been happening here. We've been the exchange rate's been supported here at least by the fact that the Australian economy has generally seemed to be doing relatively well and people are being quite happy to invest here. So to some extent we've been suffered from an embarrassment of riches rather than economies. In the last 6 months or so, the outlook in the US economy has improved quite a lot. The US central bank has contemplated actually reducing the amount of stimulus they're adding to the economy each month. And that's seen an appreciation of the US dollar go up and the Australian dollar come down some. We still think the Australian dollar, we at the Reserve Bank still think the Australian dollar is too high as of 48 hours ago. We certainly think it's too high as of today. So what's happened in the last 48 hours is that the US central bank have been widely expected to stop adding as much stimulus to the economy each month as it had been. That was the expectation that led everyone to believe. When push came to shove last night, they decided they wouldn't stop adding as much stimulus to the economy. And as a result, the US dollar has gone down, the Australian dollar has jumped up, as has almost every other currency in the world. So while, from the agricultural sector's point of view, a lower Australian dollar would have been extremely beneficial, that hasn't quite come to pass. So the question is, what can we actually do about it? What can we at the Reserve Bank do about it? One of the things that we have done about it in the last couple of years is to try and offset the impact of the higher dollar. We've been reducing interest rates, which has flowed through to lower borrowing rates now. That still doesn't affect if you're trying to sell your output overseas. It's still not affecting the amount, it's not helping you in terms of the amount of Australian dollars you're going to receive from that. But to some extent, as I said, reducing borrowing costs is trying to offset some of the impact of that. One of the things which is often brought up in these circumstances, so why don't we at the Reserve Bank intervene in the foreign exchange market and try and push the exchange rate down? So so there are a few considerations which come into play here. One is, if you think we at the Reserve Bank have to think about the economy as a whole rather than any individual sector. And we only have really a couple of instruments to do that. So one is the cash rate and one is influence on the exchange rate, which is not particularly exact. And so our assessment was that while the exchange rate was hurting particular sectors of the economy as a whole was still doing okay. And up until recently, the economy is still growing at around about its trend rate, and unemployment was still at a reasonably low level. Now, obviously, in the last few months, unemployment's risen, the economy is growing a bit softer, and partly as a result of that, interest rates have been lowered. And up until, and we have had some depreciation of the exchange rate. So one consideration is we have to think about the exchange rate for the economy as a whole, not the exchange rate for one particular sector. So while it was very clearly hurting sectors like agriculture and tourism, most obviously, in other parts of the economy, which particularly those related to what was going on in the mining sector, the exchange rate was probably okay. The other consideration, so The other consideration we have to take into account is whether, if we intervene in the exchange market, it actually has any effect at all. So one easy point of comparison is what's been going on in Switzerland. So the Swiss economy, which is about 1/3 of the size of the Australian economy, had a very large rise in their exchange rate because the Swiss are seen as a very safe place to put their money. When all the problems were going on in Europe, the Swiss franc went up a very, very long way. It went up about 20% in the space of 3 months. So if you think about the Australian context, it would be like the Australian dollar being around about $1 to $1 US, and 3 months later it would be $1 Australian dollar to $1.20 US, which my guess is most people in the room here wouldn't be all that comfortable with. So not surprisingly, the Swiss weren't all that comfortable with that when that happened, and they decided that they would put a ceiling on their exchange rate. As a result, the Swiss central bank had to buy about $500 billion worth, so $500 billion worth of foreign exchange. If you translate the Swiss economy into the size of the Australian economy, it would have meant we at the Reserve Bank would have bought about $1 trillion, so T, not B, trillion dollars worth of foreign exchange. A large number, even in financial market terms. That may have been effective in keeping a lid on the exchange rate, maybe not. The Swiss have managed to keep a ceiling on their exchange rate. They were sitting in a situation, so the Swiss economy is a lot more open than the Australian economy. They have about 60% exports. Australia is about 30%. They're also sitting, they had deflation in the economy and they had zero growth, which was not the situation in the first year. But the other consideration is that they had already reduced interest rates to zero, whereas we obviously have some scope to further lower interest rates from here. So, yes, intervention is a possibility that we can contemplate. The question is whether it will be effective. Financial markets are fairly large. As I said, we could spend $1 trillion in accumulating foreign exchange. That's a fairly large number. We also will be earning, to put it in financial vernacular, we'd be earning negative carry. What that means is the rate that we'd be receiving on our foreign exchange reserves would be lower than the amount we'd actually be having to borrow out to fund that, which would mean we'd be making losses on that every year. And that may be a price we'd be willing to pay, but the losses we'd be taking would be quite substantial, and we have to work out whether that's worth the while for the economy. So the exchange rate, I realise, is of incredible importance. The agricultural sector is something the board is very mindful of, but we have to, part of the considerations, we have to think about the exchange rate for the economy as a whole rather than necessarily any individual sector. What that does mean is, like every aspect of monetary policy, some parts of the economy do better, some parts of the economy do worse, depending on what the exact configuration of the monetary policy settings are. All of that, I suppose, means that it's a complicated assessment that the board has to make each month. Hopefully they make the right assessment. It's not necessarily one that everyone in this room would be fully supportive of if they have their druthers, but I suppose the main message I can get across to you is that the information we get, particularly through our liaison program, is the effect particularly that the exchange rates had on the various sectors of the economy over the last couple of years, and that's been very much front and centre of the board's decisions each month. So let me finish there in terms of what we do at the Reserve Bank, and let me talk a little bit about some trends which might affect agriculture in the future. And I think the two trends which are most likely to, beyond all the scientific developments which I heard about earlier today, but let me talk about two economic trends which might affect the major drivers of agriculture in the future. And really they boil down to two words, which are China and India. So if you think about, those two economies, or those two countries, are more than 1/3 of the global population. So in terms of thinking about a market, that's a pretty decent market. Secondly, one of those economies has moved now to a point sort of where their income per household is actually at a fairly reasonable level, which is China. Now, one of the things, looking back through history, as economies have developed, is that as people get richer, they tend to spend more on calories, which is getting directly to the agricultural So that's very evident in China now. So China's got to the point now where their consumption of food is a lot more calorie intensive than it ever used to be, or than it was historically, which means they're going to eat more meat and they're going to eat other foods which are more calorie intensive, but basically foods which are sort of further up the production chain. And that market is clearly one where Australia, which is something where Australia has opportunities, and hearing some of the presentations earlier today, that's something which people are very aware of. Now, one of the other aspects of China, I suppose, is they are coming from a very agricultural background, and so there's a reasonable chance that some of that calorie production is going to be met within China. But what that also means is that in terms of technology, they're a long way behind the frontier, and there are opportunities for Australia in terms of helping them with technology. So even if you can't sell your stuff grown here directly to China, there are obviously opportunities in terms of technology transfer. Now, someone explained to me earlier today that once one company transfers its technology to China, they turn around and spread that across the whole economy. So maybe there's a very large first mover advantage in getting there first before they reverse engineer the technology and take it on themselves. Nevertheless, still you're talking about a market of 1 billion people consuming a lot more calories, so it's a decent market. One of my predecessors at the Reserve Bank, Steve Grenville, as Deputy Governor, said, this particularly relates to the wool industry, if you could sell one pair of socks for a university in China, that's still 1 billion pairs of stocks, which is a fairly decent market to be taken. But if you think, so while China is fairly developed, the other end market which is not given a lot of attention to until fairly recently is actually India. So India is obviously, from a population point of view, is as large as China. Unlike China, whose population is actually about at the point where it's going to start shrinking, India's population is still growing at a fairly rapid pace, and is likely to continue to do so for a long time. So if you think back 15 years ago, China wasn't really on the radar of a lot of Australian exporters. China was well less than 10%, it's about 5% of Australia's exports. Today it's 30% of Australia's exports. That transition has happened in 10 or 15 years. India today is actually a reasonable chunk of Australia's exports, but it's actually still very underdeveloped. So if you think about a major market looking forward, India seems to be one which is very much in prospect. That said, I could have been up here 30 years ago saying India is the market which is about to take off, and 30 years later it still hasn't. So one day India will take off, whether that's tomorrow or 30 years' time, I don't know. But at least in prospect, it's a market which is very much there for the taking, and one where agriculture, I think, potentially plays a particularly large role. And again, if you think about the fact that incomes in India are still extremely low today, but way below where they are in China, if there's any prospect in India today, India in 30 years' time or 20 years' time ends up to where China is today, that's an extremely large market, which is extremely underdeveloped as of today. But that said, one of the main things you should ever learn when you hear an economist speaking about the future is that almost invariably their forecasts are wrong. That most particularly, let me back to the exchange rate. If you ever hear an economist talking about where the exchange rate is going to be over the 3 months or 6 months' time, you should turn off, because economists are hopeless at forecasting where an exchange rate is going to be going forward. So while a number of you may pay a lot of heed to what your banks tell you about where the exchange rate is going to go in the future, there's a very long track record in the economic profession that the best forecast of where the exchange rate is going to be in a year's time is where it is today. And anyone who tells you anything to the contrary probably doesn't know what they're talking about. So if you take nothing else away from what I've had to say today, is that don't pay any attention to what your banks say about where the exchange rate is going to go. That said, one thing, the main influence of where the exchange rate is going to be from in Australia over the next while, there's not going to be anything which happens here. It's going to be very much driven by what happens in the US. On the assumption that the US economy does actually start to look better, and things, the US central bank does actually decide actually, to reduce the amount of stimulus they're going to have. The Australian dollar is likely to be lower rather than higher. Given my previous replies, I should completely ignore what I just said. For all you Nuffield scholars who are about to head overseas, though, today is probably not a bad time to get your foreign exchange. But as a couple of you have pointed out to me, while you're overseas, what matters more is what the price you're actually going to be able to get for the crops you're growing at the moment, and in which case you probably want to wait for the exchange rate to be a bit lower, and you probably wouldn't be locking in what you've got today. But as I said, you should completely disregard anything I say. And on that regard, if you think that you've understood that anything I've said today gives you any idea about where the Reserve Bank's going to move the cash rate next month, you've completely misunderstood anything I've said. So let me conclude by wishing all of the future Nuffield scholars all the best. From what I've seen today in terms of the presentations, the amount of knowledge that you're going to pick up over the next year or two is going to be of immense value to the Australian agricultural sector. I was incredibly impressed by the quality of the presentations today. The other aspect, I suppose, is that I suspect you will learn at least as much from each other as you will from the people you're seeing while you're overseas. From my experience in studying overseas, often the most you learn is from your fellow students rather than necessarily from the people who are trying to impart knowledge to you. Your fellow students are often actually the best source of knowledge that you'll get. So as part of this program, I think the greatest thing you may get from it is the interaction with the people you're actually travelling with rather than necessarily the people you're actually talking to. But I still think it's the most amazing opportunity that you've got ahead of you. That, as I said, the knowledge transfer that you've got to bring back both to your own, both your own operations, but to the industry as a whole, is quite mind-blowing, at least just on the basis of the information that I saw presented today. So I wish you all the very best, and if we can help out by delivering you a lower exchange rate at the same time, we'll do our best, but I'm afraid ultimately it's mostly in the hands of my counterparts in the US rather than myself, so while trying to not completely absolve ourselves from responsibility for that, as I said, I wish you all the best and hope you make the most of